Hey guys, hope you're doing well out there. Time to take a look at one of Cathie Wood's favorite names, Zoom Video, ticker symbol ZM. Shares of this enterprise software maker were down nearly 12% year to date, but are making up for some of those losses in the after hours, as shares are higher by roughly 10.3%. As we walk through their Q4 results, which came out in the after hours, we'll really see why this stock continues to remain in the dumps really over the past, you can call it 2, 3, 4 years. And then also why the valuation on this name continues to remain extremely cheap. There's really no reason I see this one continuing to expand its earnings multiple in the near future. And then, as always, we'll take a look at it from a technical perspective and point out all the more reasons why I think you should stay absolutely as far away as possible from a name like Zoom Video. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of Zoom Video now trading at a market cap right around $19 billion, but keep in mind at one point, this was a company valued at a price north of $500 a share, and so a $19 billion market cap sure of a heck looks a lot better than it did in late 2020, where shares are still down nearly 90% from those all-time highs. Now, in terms of Q4 revenues, those came in at $1.15 billion, and that was good for just 2.7% growth year over year. Yeah, please remind me what inflation was in this most recent quarter. Pretty sure it came in higher than 2.7%. And so this company really not even outpacing inflation on their top line. That did still beat estimates on Wall Street, which were lower by another $20 million. So the expectations really weren't there for Zoom. They came in with a slight beat on that top line. And then Q4 non-GAAP EPS came in at $1.42. That also beat expectations by right around 27 cents. Now, in this most recent quarter, Zoom also announced a $1.5 billion common stock repurchase plan. We'll get more into that in just a second. But first, taking a look at guidance, this is a company that has a pretty good outlook on what their revenues and earnings will really look like, considering they cater to a large number of enterprise customers. And so they can really provide Q1 outlook and also on top of that, provide full year outlook. So first of all, in terms of Q1, which is the current quarter, we're in Zoom expecting revenues of right around 1.125 billion. The estimate was closer to 1.13, so coming in just shy on that top line. And then non-GAAP EPS expected to be right around $1.18 to $1.20. Expectations were lower at $1.13. So seems like their top line is going to come basically in line, and then they'll be able to outpace on their bottom line just a little bit. Similar story for their full year outlook, as revenue expectations were at roughly 4.66, Zoom guiding for roughly $4.6 billion, and then non-GAAP EPS coming somewhere between $4.85 up to $4.88. The street estimate was closer to $4.68. So similar story, Zoom outpacing on that bottom line, but then top line basically coming in line with Wall Street expectations. And as we look ahead to the next few basically years over at Zoom, we see on that bottom line first, this company really isn't expected to grow at all at the end of the day. And so even if you consider a $4.85 figure on that bottom line, which is what Zoom is guiding for, yeah, maybe instead of declining 5%, that'll just be roughly flat on a year over year basis. And so when you see this company trading at a cheap forward price to earnings multiple right around 12, 13 times, yeah, that's because they're really not expected to grow that bottom line in any meaningful way. Even if we look ahead 2, 3, 4 years out, this company is just expected to come up to $5 4 years from now. And so that is really insignificant growth on that bottom line. Along with that, you have basically no growth on that top line. In this most recent fiscal year, we see Zoom put up a quarter of, let's see, right around we'll give them credit for $4.53 billion on that top line. And then we see Zoom guided for right around $4.6 billion for the upcoming year. And so really, again, that would be basically 0 to 1% growth on that top line. And so this company over the next few years isn't really expected to grow their top line. You really start to wonder how Zoom is really expected to get up to this $8 billion figure in 2023. And then even for the next few years, basically no growth is what you're getting with this stock, both on a top and bottom line. And really that's what we've been seeing over at Zoom. We have the last 8 quarters. This is a slide that they provide themselves. The last 8 quarters, you see year over year revenue growth has come to an absolute screeching halt. It was at 12% back in fiscal 2023, now down to just 3% revenue growth on a year over year basis. On top of that, to make matters worse, you have income from operations actually trending in the wrong direction over the past 3 quarters, as we're down from 177.6 down to 169, and then in this most recent quarter, it came in at just $168.5 million in income from operations, and we're still well away from the income from operations we reached back in Q1 of fiscal 23 at $187 million. So this company really over the last 8 quarters has seen a massive slowdown in growth, also seeing a slowdown in the income from operations. On top of that, you have enterprise customer growth coming from 24% down to 18, then 14, and now sitting at just 3% growth on those enterprise customers. You really have to question, any enterprise that wanted to use Zoom is probably already using it. And if they're not using Zoom, they're likely using a competitor to Zoom. And so you really have to question, how does Zoom come in and grow their top line over the next few years? What is it that's going to make the stock continue to expand their top line? And you see, if they don't expand their top line, there's really no way for them to expand their bottom line other than cutting costs. And that's exactly what they did in this most recent quarter. But at some point, you're just unable to cut costs further. And so at that point, investors would really have to question what will allow Zoom to grow their bottom line earnings. Now, as we spoke, in this most recent quarter, the earnings look pretty good year over year. That's just because they were able to control expenses in a pretty meaningful way, at least on those operating side. So you see revenues up just $20 million. That's year over year, basically no growth as we saw. And then your cost of revenues went down $20 million year over year. And so your gross profit went from 823 up to 870, adding roughly $40 million. And then your operating expenses, that this is really where Zoom was able to control costs. As you see, R&D ticking down roughly $50 million, sales and marketing coming down by roughly $130 million, and then G&A also ticking down by roughly $50 million. And so your operating expenses went from 953 all the way down to $700 million in this most recent quarter. And so from an income from operations, you turned it around pretty substantially, up from a loss of $130 million now to an income from operations right around $168 million. And so on a year over year basis, like we said, it looks pretty good as Zoom was able to control those costs. But as we look ahead to the next few years, if they're really unable to grow their top line in any meaningful way, really at what point does Zoom stop being able to control these operating expenses and struggle to really grow their bottom line in a meaningful way? As we move down to their statement of cash flows, we also see this company pay out just an egregious amount of stock-based compensation. You see in this most recent quarter, off of just 298, we'll give them credit for $300 million in net income. They pay out roughly $254 million in stock-based compensation. Keep in mind, that's actually a fantastic change from a year ago where they were losing $100 million and paying out nearly double in stock-based compensation expense. Still, for the full year, off of just $600 million in net income, you pay out nearly $1 billion of stock-based compensation. And so when you see their weighted shares outstanding on a diluted basis actually ticking up pretty meaningfully year over year, you begin to question that share buyback is really just expected to mitigate this massive amount of share-based compensation. And to the bulls out there for Zoom Video, you'll probably come in the comments and let me know, yeah, this company is sitting on a ton of cash and cash equivalents. And certainly that's absolutely correct. I'm not going to argue that this company doesn't have a ton of cash. You're sitting on roughly, we'll call it $7 billion in cash and cash equivalents and just roughly $2 billion in total liabilities. So you're sitting at roughly 3 times cash than total liabilities. But keep in mind, the amount of stock-based compensation this company pays is the reason why they are able to sit on so much cash. You have to pay your employees over at Zoom in one way or another. And it seems like so far, Zoom has been paying their employees in stock. And if you were to pay your engineers over at Zoom in cash, some of them roughly 200, 300, 400,000 US dollars every year, yeah, your cash pile might not look so good after all. And so you have to consider the fact that this company has been paying out so much stock-based compensation is one of the big reasons why they're able to sit on that cash pile of roughly $7 billion. And really what that does is it brings down their enterprise value. You basically take your market cap, add your net debt, and then subtract off your cash, and you get to an enterprise value right around $13 billion. And so from that perspective, certainly not expensive, but keep in mind, this company still pays out a boatload in stock-based compensation. And so if you want to see this go down in a meaningful way, Zoom will have to continue paying their engineers in one way or another. And likely that will be through cash, bringing down their cash pile on the balance sheet. And so that's just something to keep in mind as you walk through these financials. All things considered, year over year paints a good story, but really it comes down to the fact that how this company will continue to grow really top line revenues in the near future. It's looking like controlling cost is working for Zoom in the current moment, but at some point that will stop working, and it'll really come down to how they're able to grow their top line, whether that's done organically or inorganically. The other thing I actually wanted to point out was how this company uses share repurchase plan. You see back in 2022, yeah, this is calendar year 2022. This was the end of their fiscal year 2023. And so this company bought back nearly $1 billion worth of their common stock back in calendar year 2022, likely when the shares were nearly double at $120, $130 a share. And so considering this company did put a $1.5 billion buyback in place, doesn't give me the utmost confidence considering how much stock they had bought back at an elevated level just 2 years ago. Certainly at this point, this company sitting on a ton of cash doing a buyback does make somewhat of a sense, but the fact that they can likely continue to use that cash in order to do acquisitions, something actually I would like to see Zoom do instead of maybe buying back a ton of stock. Moving on to the technicals, you can pull up a 4 or 5 year chart of Zoom. Basically paints an extremely ugly picture. You had a massive rally back in 2020 to highs of nearly $550 a share. Since then has been in a massive decline, down nearly 90% from its all-time highs, and it's been basically locked in this downtrending channel of lower highs and lower lows. You are popping up close to the upper end of it at near $70 a share in the after hours. I expect this one to come up here, retest these highs at right around $72, and then just get rejected from there. Really, if you want to get into shares of Zoom for some reason, if you are bullish on this company, basically saying that you're okay with being in a company that is not growing on its top line or bottom line in a meaningful way over the next 5 years, you can really call it. Yeah, your first level to get into shares of Zoom is really when it would make a meaningful break above its previous set of highs, right around, we'll call it $75 a share. You want to see a break above that and then a pullback or a retest back to the top end of this trend line and then continue to move higher from there. At that point, you would have confirmed a higher low and a set of higher highs, and then from there you're in a uptrend, now breaking out of this downtrend. And so really your first level to buy shares of Zoom would be on a retest back to this trend line right around, we'll call it $72, $73 a share. But before that, you do want to see a decisive break above your previous set of highs at $75 a share. Really, you want to see the stock get all the way up to your previous set of highs right around, we'll call it $82 a share. Certainly if Zoom doesn't do that, I expect this one to get rejected at these levels and then continue to trade lower in this downtrending channel. Really, there's no reason to pick up shares of Zoom from this perspective. The fact that it's in a technical downtrend, and then on top of that, you have a company that's basically in flat to decline mode over the next few years. Really, I don't see them expanding their top line sales in any meaningful way, at least based on their current product suite. Certainly if they come out with a product that differentiates them from their competitors like a Microsoft Teams, like a Cisco WebEx, then yeah, possibly this company can continue to expand their top line sales. But if they really continue to have their flagship Zoom product, really any enterprise that's been wanting to use Zoom has already signed up for Zoom, and anyone that's not using Zoom is probably using a competitor. The fact that this is still a top 7 position in Cathie Wood's ARK Invest portfolio is absolutely egregious in my opinion. And the fact that at one point this was her top holding in this ARK Innovation ETF just shows me her strategy really works in bursts, but really isn't a long-term sustainable way of investing. And the fact that Zoom is considered a disruptor in this space, yeah, I just don't see how that comes to fruition for a company that's basically not growing its top or bottom lines over the next few years. That was my take on Zoom Video Communications, a stock that looks cheap on the surface, but really is cheap for a reason, and one that I personally would stay away from. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.